And good evening. This is the Elliott Wave update for the NASDAQ 100 for Wednesday, June 15th, 2022. They came, they saw, they raised rates 3/4 of a point, and then they went away. The markets were very cautious leading up to that number, but pretty much in line with what I had anticipated and basically expected as a response. The initial response was to buy it, then it was to sell it, then it was to sell it hard. And then Fed Chair Powell came to the podium and he started to speak, and that just proved to be much more to the liking of market participants. And then we set about putting in a very strong response where both the Dow was up 500, the NASDAQ was up 400 something, the S&P was up 100. It moved very solidly higher. And then I suppose reality or whatever set in, and pretty much right off the high in the NASDAQ at 11,794, it just started to come down. Right now, we're down 170 points off that high. And so what does all this mean? Well, in terms of interest rates, I think Powell was making it pretty clear that the battle to fight inflation is on. Inflation can be very stubborn. They intend to continue to be aggressive. But to ease everyone's worry, they said that the possibility of getting another 3/4 point hike is not really in the cards just now. Now, again, before any greater decisions about the market can be made and about what direction we're really going to go in over a mid to longer term, really depends on how much the Fed actually can get all of this in control. So it's becoming more and more interesting in that we need to just take that wait and see attitude, but we also need to continue to trade each day. And so we have to follow price action. We have to follow what basically the Elliott is telling us. And whether I have my degrees right or whether I have the actual -1, -2 in the correct place, I will go back and review that. More importantly, though, is that I continue to follow that we did within here. We did 5 down and now we're doing 3 up. And that 3 up is pretty clean. Right now, it's very clean. It's not going to be the nicest little picture, but if you can see, we got an A and a B and we got a great C. This little blurb in there was pretty wild, but if I take it over, it makes it much clearer. If I just put it on a line chart, you're going to see that it's a lot clearer. There's the A, there's the B, and then we get the C wave coming up. Now, whether or not it is complete, I don't know yet. The market's not really sharing that information with us. But there's the 5, and then we have an A, B, and now we're up in the C. So I need to continue to allow for continued upside. Remember that resistance zone. Let me go back out to the daily, and I can put at least that one back on, and then I'll take it down to put the other. And we're just looking at from there. Yes, down to there. We have, well, it's actually a little bit off, but it's 11,900 on this chart. And actually the other one that I had, which was more exact, was at 11,880. So I continue, let's call it that, 11,880 up to 11,907. And that'll be the zone. But that's the potential. And that would put it into the category of like the most common fourth wave would be to get it into there. It has already surpassed the top of the wave 4, which was one beginning point. But now we're back and now we're using our Fibonacci's. But you can see on the daily, it kind of went up. It broke above this very minor resistance, came back down, broke above it, came back down, and is now closing below it. So this break above the 4 is not affected. So it's not really letting us know, oh, gee, okay, so we're showing some strength in the market. The move itself, the bar's pretty solid for a daily, but I needed to see it close above this 4 to give more strength to the fact that, okay, we're going to keep going. So that part is still out there. Now, taking it back down to that hourly chart, what we have going on is, again, just the interpretation. But now that the Fed is out of the way, our next big stumbling block or roadblock or whatever we want to call it is this gigantic expiration that is due on Friday. That may continue to support higher prices. Now, remember that we were talking yesterday about the fact that we saw all this downside action over the last several days. So that gamma explosion was to the downside. And so we had all of the adjustments to all of these positions being made as they slid through strike prices in all of these major NASDAQ stocks, in fact, in all the NASDAQ stocks. So now we had this big, huge rally. And again, what we're seeing over the last couple of days, that's what now they have to reverse. So the reverse is now happening, and that they're now seeing it slide and run back up through strike prices, and it is causing the adjustments back in line again. So that's adding to all of it. So I think that's going to continue to come into play tomorrow and again on Friday, the actual expiration day. Just want to take a peek what we have in terms of any economic. So tomorrow we have housing starts, jobless claims, and the Philly Fed, all before the opening. They are market movers. They can be, I should say, market movers. Depends on how they come out. And then we have industrial production on Friday, plus just the major quarterly expiration cycle. So we still have some different things that may come in. Now, if jobless claims come in showing inflation, if housing starts come in showing inflation, Philly Fed comes in showing Philly manufacturer shows inflation. Well, I don't know how the market's really going to interpret that, because they're now in this space where it's like, well, he said that it's going to continue, but they're going to get it under control. So again, how much power that will have to really advance or force the market lower, yet to be seen. So my recommendation continues to remain not being bullish, not being bearish, that we are trading the price action. In fact, if somebody had to say, why aren't you one or the other? It's like, well, I'd like to be both, because I'd like to see the movement in both directions, please, in large moves. It makes the trading easier, it makes the trading better, it makes our P&Ls better. Now, what can we expect for tomorrow? I think we need to leave open the potential that the market will run up to that 382 level. And this is why this is way off. Let me reset that. Come on, come on. That's going to make me crazy, so I'm not going to do it the old-fashioned way. I'm sorry. We're just going to go here, go to the edit properties, bring this down, say, what is this level? This level is 846. All right, and the endpoint is 236. Let's get these numbers exact, and I bet you we'll come up with that same level. Here we have it again. Now we're actually a little bit lower. I had 880, now it's 851, which is fine. So we need to leave room, or the process, to actually get up and get to this level. Now, beyond that, I would not be expecting. Here we had the 30-minute 200 come into play. Let's look at the hourly. And let me just double check on where that was. I don't remember. It's still sitting up pretty high. The hourly 200 is sitting up at 11,989. It remains in play because if they just decide that this was a major bottom and then we're just going to go and go and go, then that comes into play and it would come in as resistance. But on the hourly 50, we're well above it. In fact, the 4 and the 8 zipped right through it. The 20 sitting right below it. If that kind of pops up, it's going to put a little bit more emphasis on the market continuing to move higher and likely getting up at least into this 11,850 area to complete the move. The structure itself is rather confusing because we had this in the middle of it and it actually formed a doji. So it's just presents itself a little bit more challenges. So, but if anything I had to say is like it's an A and a B. And then we've got the C wave, 1, 2, 3, 4. And then what all this is, I don't know, but it's likely, you know, if we had to go on a closing basis, like I showed you before, we're still in the C wave, a little decline, and then another rally, possibly. If the market starts to break down from here, then we're likely going to have to consider that that did complete the minute wave 4, and now we're going to drop, putting in a minute wave 5. That would be a surprise, I think, to the market because now everybody's changing, going like, okay, everything's okay, we're going up, blah, blah, blah. But may not. And again, we've still got a lot of things to get through before it is in the clear to rally. There's still enough negative, there's still enough going on that this is just a one-off, boom, we got it. We did once again our, whew, that's out of the way. We accept 3/4. We like what you said, Mr. Powell. And now we're going to go back to like buying. Possibly. Everything's a possibility. But I would intend to think upside remains alive with the possibility of getting up to 11,851. I'd have to start to really break this thing down if I look at the 15-minute chart, just so that we can see some of the internals that happened in that hour, because that last hour was produced a lot of jerking around. So again, this is not really full of information in terms of what comes next, other than it made that high and slid right off of it in glorious NASDAQ fashion. So on the 15-minute, you see we're already back down below the 4 and the 8. 20 is next in line, and then we've got the 50 and the 200, again, 15-minute chart. If we start to take it up, you're going to be able to pick your points where if this market starts to break through these moving averages, it's really going to be signaling that we're headed lower yet again. So we would be looking for number one, it is kind of sitting right at that support level at 11,616, 15, right in there. It's bouncing up and down above it and below it. Hidden in there is the 4. Then we have the 8. Then we have the 20. This is on the 30-minute chart. Significant would be that if it comes down and breaks the 30, which is at 11,540 right now, and then back below the 50, which is at 11,484. A break there would suggest that, yep, that completed it, and we're likely now heading lower, putting in a new low below 11,236. Let me go back out to that hourly chart, and let's just take a peek there before I put up the other Fibonacci extensions for the downside. So here, this is all looking pretty good in terms of that is 1, that's 2, that's 3, this could be 4. We put in a 5. And then again, we're in that window of, gee, is it minor 3, or is it actually just an extended minute wave 1? And that will still be out there, but we'll view it and we'll consider it if and when it happens. So right now, I'm going to be leaving this open, that we need to leave open the potential for additional upside, reaching resistance. We have the daily 8 at 11,953. bringing it back down to the hourly. We have also at that level, but at 11,989, the hourly 200. So we have moving averages that should provide resistance for a continued push higher. And also the Elliott does not suggest that we're going to get up that high. Although it'd have to go pretty far to actually break the rule. I also have to go on the look and the feel, and it just would not be correct if it goes too much higher than what we have. So there's our upside. We're getting our downside view. I would expect that it's going to continue to be pretty volatile. We did see volatility come off. One thing that I am now looking for in terms of for this expiration coming up, that they're going to begin to more solidly knock volatility down, take the premium out of these options and push the volatility lower. And so I thought that would start today. It basically has. I thought it would pick up after the interest rate news came out, and it did, but not as heavy as I thought that they would. So we have our upside scenario. We have our downside scenario. We know what to look for in terms of if the market breaks in one way or the other. If it starts to break down, we've got all those moving averages in the way to give us support and possibly hold it and turn it higher again. Okay, I'm going to leave it right there. Our next update will be on Thursday, June the 16th.